All right, let's dive right in today. We're taking a look at financial strategies, specifically this idea of a wealth perpetual motion machine.
Perpetual motion, huh?
Mm.
That's pretty ambitious. I'm interested to see what we've got here.
Yeah, will you send over some excerpts from a couple PDFs, 250307.pdf and 250352 Elia, 2-0315 PDF. They seem to lay out kind of a unique way to build wealth. We're going to unpack how it works and see if there's anything we can all learn from it.
All right, sounds good.
So they start off with this really interesting analogy comparing investing to a video game. It talks about having a long life bar, which means keeping your investment costs low, and then plenty of ammo, which is like having stable dividends.
Okay.
And then accumulating treasures is like, compound growth.
Makes sense.
The goal is to get to infinite mode in the investing game.
I like that. It's a good way to frame it. You know, a lot of people get caught up in those short-term gains.
Yeah.
But this infinite mode idea really emphasizes the importance of thinking long-term.
Right.
It's more like you're building a system, not just chasing quick wins.
Yeah, like designing a video game character that can survive anything the game throws at you.
Exactly.
So to reach infinite mode, they say, this wealth perpetual motion machine is built on three main things.
Okay.
Controlling your costs, reinvesting your dividends, and then, of course, that compound growth magic.
Makes sense. Those are some pretty classic investing principles, but I'm curious to see their take on them.
Yeah, they dive a little deeper than the basics. Like with cost control, they have this intriguing water level metaphor.
Water level.
Yeah, it represents the ratio of your investment cost to its current market value.
Okay, so like a ship, right?
Yeah.
The lower the center of gravity, the more stable it is.
Exactly. So a lower water level would mean your investments are less vulnerable to all the ups and downs of the market.
I see. So like, let's say you buy $1 million worth of stocks, and those stocks go up in value to like 1.2 million.
Okay.
So your water level would then be 83%.
And how'd you get that?
Just divide the original cost, which is the million, by the current market value, the 1.2 million. The lower you can get that water level number, the less you'll feel the market swings.
That's a really cool way to visualize it.
Right.
So it's not just about buying low, but also about managing that water level over time.
Yeah.
And I saw they mentioned dividend reinvestment a lot in the source material. How does that play into all this?
Dividend reinvestment is like, well, think of it as adding weight to the bottom of that ship we were talking about.
Okay.
You're basically buying more shares at a lower cost every time you reinvest those dividends.
And that lowers the water level even more.
Exactly. And that puts you in a good position to get even more dividends later on. Sort of a self-reinforcing cycle.
Ah, I see. Lower cost, more dividends, even lower cost. Like a snowball effect.
Right. And that brings us to that third piece of the machine.
Yeah.
Compound growth. They say it's the engine that drives the whole thing.
Yeah. Compound growth. Gotta love it. Always a popular topic.
Yeah. And they had this example. They said, imagine an investment that consistently earns 5% every year.
Okay, 5%.
Doesn't sound like a lot, right?
Okay.
But after 10 years, your initial investment would have grown by about 63%.
Wow.
Then after 20 years, it more than doubles. And after 30 years, you're looking at over 4 times your original investment.
That's the magic of compounding, right? It's about those steady gains over the long term.
They compared it to planting a tree.
Okay.
You wouldn't dig it up every week just to check if it's grown, right?
Right.
You got to be patient. You plant it, take care of it, and let it grow over time.
So with this wealth perpetual motion machine, it sounds like patience is key.
Definitely. It's not about trying to time the market or make a quick buck. It's a system for steadily building wealth over the long haul.
Awesome. So it seems like we've got a pretty good idea of the foundations of this wealth perpetual motion machine. We've got our blueprint. Now we need to figure out how to build it.
Exactly. And those documents you send over have some practical strategies for doing just that.
Perfect. So that's what we'll dig into next time. All right, so we've laid the groundwork for this wealth perpetual motion machine. We talked about controlling costs, reinvesting dividends, and the power of compound growth. Now let's get into the details. How do we actually put this thing together?
Well, the 250315 document goes into some practical strategies, and it all starts with picking the right stocks. You might think it's all about chasing those high dividend yields, but they cautioned against that.
Oh, really? So it's not as easy as just picking the stocks that pay out the biggest dividends?
No, not necessarily. Remember that infinite mode analogy. For that sustainable growth, they suggest taking a more holistic approach.
Okay.
They really stress the importance of looking at a company's dividend history, like how long they've been consistently paying them out, and their overall financial health, and even the stability of their industry.
They use this term ASIG a lot, which means initial dividend yield. It almost sounds like they're saying a really high yield could be a red flag.
Yeah, sometimes it is. A super high dividend yield could be a sign that the stock price has dropped recently, or maybe there are some issues with the company that you need to be aware of.
So you don't want to get tricked by a one-time big payout.
Right. You want to look for companies that have a history of consistently paying out dividends.
Got it. So it's about finding a good balance, a decent yield from a company that's reliable. What about a company's OLNG, their dividend payout ratio? They mention that a lot too.
Yeah, the payout ratio is really important in this system. They suggest looking for a ratio between 30 and 70%.
Right.
Anything higher than that. And the company might be stretching itself too thin. You know, they might not have enough money left over to grow or to handle a downturn in the market.
That makes sense. Sustainable dividends are key. But it doesn't stop there. They also talk about stock price stability. How does that factor into this wealth perpetual motion machine?
We'll think back to that ship analogy and the water level.
Okay.
If the stock price is really volatile, that water level is going to be going up and down all the time.
Oh, right, like a choppy sea.
Exactly. And that makes your portfolio less stable. They say that having stable stock prices is crucial for maintaining a lower water level, which helps to minimize risk.
It's all starting to connect now. So we're looking for companies with a solid history of paying dividends, stable stock prices, and wait a minute, the document also talks a lot about hone corporate governance. It seems like they're looking at more than just the numbers here.
Yeah, it's interesting. They're not just focused on the financials, they're also encouraging investors to look at how a company is managed,
Okay.
how transparent they are with their shareholders, and how they treat their employees. They even suggest looking into a company's board of directors.
Wow, that's pretty in-depth.
Yeah, to see if they're committed to creating long-term value. It's a different way of thinking about dividend investing.
It's almost like they're promoting a more ethical approach.
Yeah, I think so. You're not just buying stocks, you're investing in companies that you believe in.
Companies that are doing things the right way.
Exactly. Companies that you think will make a positive impact on the world and also give you good returns.
All right, so we've got our criteria for picking stocks, but what about timing those investments? There's a whole chapter on mastering investment timing.
Yeah, and they're not saying you should try to predict the market or anything like that. They actually emphasize recognizing market consolidation periods. It's about being strategic and waiting for those times when the market calms down a bit and stock prices stabilize.
So it's like waiting for a sale at your favorite store.
Exactly.
You know those shoes you've been wanting are eventually going to go on sale. Why not wait and get them at a better price?
Right. And these consolidation periods are a good opportunity to buy stocks at a discount, which lowers your water level even further. They suggest using some technical analysis tools and paying attention to market sentiment to figure out when those opportunities might come up.
So it's a combination of patience and being ready to make a move when the time is right.
Yeah, they also talk about using U&O, which is batch investing or dollar cost averaging.
I've heard of that.
It's a good strategy, especially for the long term. You're spreading out your investments over time instead of putting all your money in at once.
Right. Like at a buffet, it's better to try a little bit of everything instead of just piling your plate with one dish.
Yeah, exactly. You don't want to put all your eggs in one basket.
But it doesn't sound like they're advocating a completely hands-off approach. I see a section here about managing your PUDO, that's cost water level, after you've bought your initial stocks.
Yeah, they're big on regularly reviewing your portfolio and making adjustments as needed.
Makes sense. Things change, the market changes.
Right. You need to make sure your portfolio is still in line with your goals and your risk tolerance. It's like giving your wealth perpetual motion machine a tune-up to keep it running smoothly.
So it's not a set it and forget it type of thing. You got to stay engaged.
Yeah, it's an ongoing process. It's not just about picking the right stocks and then sitting back and hoping for the best. You need to actively manage your portfolio.
That brings up something we haven't talked about yet, the human element of investing. The document spends quite a bit of time on ACE risk management and the mental game of investing.
Yeah, that's an important part that often gets overlooked.
Investing can be emotional, especially if you're in it for the long haul.
Definitely. They acknowledge that market volatility can be hard to deal with. They suggest using tools like diversification and stop-loss orders to help manage your risk and keep your emotions in check.
Those are good strategies for making sure you don't make impulsive decisions that could hurt you in the long run.
Right, and they really emphasize having a long-term perspective. It's all about having that discipline to stick to your plan, even when the market is going crazy.
So you don't panic and sell everything when the market dips.
Exactly. Remember, this wealth perpetual motion machine, it's a marathon, not a sprint. And to help investors stay on track, they suggest using egg portfolio simulations.
Oh, interesting. What are those?
They're basically a way to test your strategy against historical data. You can see how your approach would perform in the past, which can give you more confidence in your decisions.
That's pretty cool. So you're not just going with your gut, you're actually looking at real data.
Yeah, it's data-driven and hands-on. It's like studying the weather patterns before you set sail.
I like that analogy. So we've got the blueprint, the tools, and the right mindset. But how does it all work in real life?
That's where those real-world examples come in. The documents have a whole section on case studies of how this approach has worked for different investors.
I'm really interested to see those. It's one thing to talk about the theory, but seeing how it actually plays out in the real world is a whole other thing.
Exactly, and they don't just show the success stories. They also analyze the cases where this approach didn't work out so well, which is really valuable, I think, because it gives you a more complete picture.
Okay, so we've covered a lot of ground with this wealth perpetual motion machine. We've talked about the principles, the strategies, but now I really want to see how it all works in practice. Does this thing actually hold up in the real world?
Yeah, and those documents you send over, they actually have a whole section on that Bashi, which is like case studies. They go through some real examples of how this approach has worked for different investors.
Awesome. I think those case studies will be super helpful. Seeing how it actually plays out with real people making real decisions.
Yeah, I agree. And it's not just about the successes. They actually analyze some cases where it didn't work out so well, too.
Oh, interesting. So we get to see both sides of the coin.
Exactly. Which I think is important because
Yeah.
no strategy is perfect, right?
Yeah.
You got to understand the potential downsides as well as the upsides.
Right, totally. So what are some of the key takeaways from these case studies? Like what sets the people who were successful with this approach apart from those who weren't?
Well, one of the big things that jumps out is that stock selection is really crucial. Like we were talking about before, focusing on companies with a long history of paying dividends, strong financials, good corporate governance,
Yeah.
all of that.
Yeah.
They looked at some cases where investors did that really carefully, and they were able to weather the market ups and downs and achieve some pretty impressive long-term growth.
That's great to hear. It's like they built a really solid ship that could handle any storm.
Exactly. And on the flip side, some of the investors who didn't do as well, they kind of fell into that trap of chasing those high dividend yields without doing enough research.
Ah, yeah, that makes sense. Like we were saying before, sometimes a really high yield can be a red flag.
Yeah, for sure. You might mean the stock price is tanked, or maybe there's something going on with the company that you need to know about.
Yeah. So it's really important to understand why that yield is so high. You can't just jump in without doing your homework.
Exactly. It's like making sure the engine of your ship is in good shape before you head out to sea.
Right. That's a good analogy. What other pitfalls did they highlight in the case studies?
Well, another one was getting too attached to a particular company or industry. They showed how important it is to diversify your investments.
Right. Spreading your bets.
Exactly. Even with this wealth perpetual motion machine, you can't just ignore the fundamentals of investing.
Yeah. Diversification is key. It's about building a portfolio that can adapt to different economic conditions.
And speaking of adapting, the case studies also talk about the human element, the emotional side of investing.
Yeah, I was just thinking about that. It's so easy to get caught up in the hype or the fear, especially when the market is going crazy.
Definitely. They talk about how fear and greed can lead investors to make some pretty impulsive decisions that end up hurting them in the long run.
So how do you avoid that?
Well, they really stress the importance of building that mental fortitude. It's all about sticking to your plan, even when things get tough. Remember this wealth perpetual motion machine, it's a long game.
Yeah, it's a marathon, not a sprint.
Exactly. And they suggest some tools that can help with that, like those, the portfolio simulations.
Oh, yeah, those are really cool. It's a way to take some of the emotion out of it, right?
Exactly. You're looking at real data. You're seeing how your approach would have worked in the past. It can give you more confidence to stay the course.
So it's like having a practice run before the real race.
Right, exactly. And I think that's one of the key takeaways from these case studies, this wealth perpetual motion machine, It's not some magical get-rich-quick scheme.
Definitely not. It's not a guarantee.
Yeah, it's a framework, a set of principles that can help you build wealth over time.
But it takes work. It takes discipline.
For sure. And you have to be willing to adapt as you go.
Totally. So it's not for everyone, but for those who are willing to put in the effort, it can be a really powerful tool.
Exactly. It's about taking control of your financial future, thinking long-term.
And building a system that works for you.
Right.
This has been a fantastic deep dive. I really appreciate you walking us through all of this.
Yeah, it's been fun.
We've learned a lot about this wealth perpetual motion machine, how it works, the strategies, the real-world examples.
And hopefully our listeners feel inspired to explore this approach and see if it might be a good fit for them.
Absolutely. And remember, this is just the starting point. Do your own research, stay informed, and don't be afraid to experiment.
You know, find what works for you. There's no one-size-fits-all solution when it comes to investing.
So true. Well, thanks again for joining us on this deep dive. And to all of our listeners out there, keep learning, keep exploring, and keep building that financial future you've always dreamed of. All right, let's dive right in today. We're taking a look at financial strategies, specifically this idea of